Hi, this is financial accounting. Financial accounting is a process which inputs the financial transactions of any business and it results into important information in terms of financial statements. This information is used by financial managers for decision making. For understanding the output from the financial accounting, it is necessary to understand the terms which are relevant in the practice of financial accounting. So, in this session, we will discuss all the financial terms under the five major categories. These are the capital, asset, liabilities, expenses, and revenue. And the terms which are not being covered into under all these five categories will be discussed under the heading Other. So let's start with number one, it's capital. Capital can be defined in three lines. The capital is amount invested by the owners in the firm. It may be brought in the form of cash or may be brought in the form of assets. And number three is it's an obligation for the business entity. This point will be discussed in the upcoming slides. Let's take an example for the better understanding. Mr. Ram is an entrepreneur and wants to start a new shoe manufacturing plant and he has rupees 1 lakh in his hand. He invests this 1 lakh rupees in starting this business, the shoe manufacturing factory. So this 1 lakh rupees which he wants to invest in the shoe manufacturing factory will be known as capital. Number two, assets. As on the last slide, we discussed how Mr. Ram spends rupees 1 lakh in manufacturing the plant. He built up a plant by investing rupees 1 lakh and that plant was for manufacturing of the shoes. So this plant has incurred 1 lakh rupees and it will be known as asset for the company. So there are three characteristics of any particular asset, that it is bought by a particular amount of money and it accrues some profit or some earnings or some benefit in the future, and if any additional asset is added in the business, it will enhance the earning capacity of the business. An asset can be classified in the two categories, the fixed asset and the capital asset. The fixed asset are also known as the long-term assets. It accrues the benefit for more than 1 year. Let's take an example of the fixed asset. Fixed asset can further be classified into two categories, the tangible fixed asset and intangible fixed asset, which also includes intellectual property rights. Intangible assets, we may include land, building, plant, machinery, equipment, furniture, and fixtures. And in intangible assets, we may include goodwill, patent, and trademarks. A tangible asset is an asset which can be seen and which can be touched. And an intangible assets cannot be seen and cannot be touched. For example, goodwill we cannot touch and we cannot see how as the reputation of any particular person or the company is. And another category of the assets is current asset. Current assets are those assets which are convertible into the cash within 1 year. For example, cash, marketable securities, inventory, debtors, bills receivables, prepaid expenses. Number three, liabilities. Liabilities can be explained in two lines. A liability represents the financial obligation or the debt which is owed by the company to different parties, such as suppliers and lenders. It represents the sources from which the funds are raised. Let's take an example for better understanding. Here are two persons in our example, Mr. Borrower and Mr. Lender. Mr. Borrower needs rupees 50,000 as loan. He requests Mr. Lender that I need a loan of 50,000 rupees. Could you please give me 50,000 rupees as loan? Mr. Lender says, that's okay, I'll pay you the 50,000 rupees as loan, but you promise me to repay. So here Mr. Borrower exchanges his promise and Mr. Lender pays a loan of 50,000 rupees. Here, the liability has been created on the account of Mr. Borrower because he will have to pay 50,000 rupees in future on a particular date predetermined in the contract. Liabilities can be classified in two categories, the long-term liabilities and the current liabilities. Long-term liabilities are also known as non-current liabilities. A long-term liability is a financial obligation which are payable after 1 year. For example, long-term debt and long-term loan taken from the financial institutions, banks, and other lenders. A current liability is a financial obligation which are payable within 1 year. For example, short-term loan, creditors, bills payable, provisions, and outstanding expenses. Number four is expenses. Expenses can be explained in one line only. An expense is a cost incurred by a business in the process of earning revenue. On the very first slide, we had taken an example of Mr. Ram who wants to start a shoe manufacturing plant. So in starting and running the shoe manufacturing business, Mr. Ram will have to spend some money for setting up the plant and for doing and purchasing other things and other transactions in the business. Expenses can be categorized in two ways, the operating expenses and the non-operating expenses. An operating expense is an expense incurred by an organization that relates to its main activity. For example, if Mr. Ram is running a shoe manufacturing factory and in manufacturing of the shoes, he may incur some expenses in maintenance of office and he may pay some commission to the sales agents and may incur some advertising expenses for his brand or his factory and then may pay some rent for the factory premises and some other utilities. So all these expenses which are related to manufacturing of the shoes and selling of the shoes to its customers are termed as operating expenses, and all other expenses which are not related to manufacturing of the shoes but are incurred by the business will be termed as non-operating expenses. For example, interest paid on loan, loss due to the lawsuit, and amortization expenses. Number five, revenue. Revenue can be explained in two lines. Some revenues are generated from the sales of the products and the services by the organization to its customers, and some revenues which are generated from the other sources such as commission received and interest received, payment received in terms of rent, royalties, and the dividend. Many of the times, revenue which are generated from the sales are known as revenue generated from the operations or operating activities, and revenues which are generated from the sources other than the sales are known as revenue from the other than operation or non-operating revenue. After covering all the five headings including capital, asset, liability, expenses, and revenue, we will cover rest of the terms under the heading others. Number one, profit. A profit or loss can be defined as a difference between the revenue and the expenses. Let's take an example. If Mr. Ram manufactures a pair of shoes by incurring a cost of rupees 90 and he sells the pair for rupees 100, so Mr. Ram earns rupees 10 as a profit. And on the other side, if he incurs a cost of 110 but could sell for only rupees 100, he will incur a loss of rupees 10. Number two, gain. A gain is a profit that arises from the transaction which are incidental to the business. such as gain from the sale of fixed assets, winning a court case. A gain is also termed as something which is not related to the operations of the business and which is irregular to the business. Number three, discount. A discount represents the reduction in the price of the goods which are sold by the business to its customers. A discount can be availed or can be provided in terms of a trade discount and a cash discount. Number four, voucher. Whenever any sort of transaction, for example, sale of the goods and services or purchase of raw material or any other transaction happens in the business that results into some support document which can be used in the financial accounting. That support document will be termed as voucher or a bill to the transaction. Number five, goods. It refers to the items that are traded by the business, such as laptop, car, bike, and in case of Mr. Ram, it was shoes. Number six, drawing. It refers to money withdrawn or the goods taken by owner from the business for his or her personal use. In case of Mr. Ram, because he was manufacturing shoes, so if he takes a pair of shoes for his personal use, it will be termed as drawings. Number seven, stock. Stock refers to goods which are kept in the inventory for sale. A stock can be a closing stock and an opening stock. So in this session, we covered all the major key terms which are used in the practice of financial accounting under the five major heading and one other heading. So that was all for today's session. Thanks for listening.